Use indexing strategies to not lose your money. In this episode, we are going to dive deep into the question, how can I make money and then not lose it when the market crashes? My name's Doug Andrew, and I've been doing this for 45 years. What's this? Helping people optimize their financial assets and minimize unnecessary tax and protect their hard-earned money from loss, especially during market crashes. It's actually easier than you think, but you wouldn't believe how many financial advisors and asset managers in America have no clue about what I'm going to share with you right now. It's going to blow you away. We're going to talk about indexing as a strategy. Most advisors go, oh, I know what an indexed mutual fund is. I'm not talking about an indexed fund. What's an indexed fund? That would be a mutual fund where you are diversified into an index like the Standard & Poor's 500 or the Dow Jones or the Russell 2000. I'm not talking about that. Do you know that back in 1974, I got my Series 1 securities license? They don't even offer that anymore, by the way. It's like the equivalent of a Series 6, Series 7, 63, 24, all of them combined. See, I could sell any stock, bond, or mutual fund out there, but I realized that when people had their money in the market, you had up times, you had down times. It was like a person with a yo-yo, hopefully walking up some stairs. But there are periods of time where that person with a yo-yo is walking across a flat surface, meaning the year 2000 to 2012. In that 12-year period, the market went up in 2000 and 2001 after the terrorist attacks. It went down, down, down 40%. Then it came up back to the break-even point again in 2007. Then it went down again in one single year, 2008, 40%. And by 2012, it was barely back up again. So see, it was going up and down. The yo-yo was going up and down, but they were walking across a flat surface. They weren't walking upstairs. Because the S&P, the Dow Jones, was basically in 12 years where it was 12 years earlier in the year 2000. We call it the lost decade because people didn't really make anything. In fact, because of inflation, even an inflation rate of 3%, they were losing purchasing power. Even though they got back to the $1 million amount, that $1 million could not buy the same gallons of gas and loaves of bread that the $1 million could in the year 2000. Does that make sense? And so what I began to learn clear back then in 1980, E.F. Hutton, who was a major brokerage firm in America, and they came up with the idea of getting rid of the market volatility. But see, a lot of broker-dealers, they make their money by your money being churned in the market. And frankly, they make fees every time they can churn and do that. I would rather have a very inexpensive approach where I can make sure that I make money when the market is doing well, but I do not lose when it goes down, and I'm going to share how to do that. So my favorite vehicle for serious cash is what I call the laser fund, because it allows me in the Internal Revenue Code to accumulate my money tax-free and then be able to access my money tax-free. And I don't have to wait till I'm 59 and a half to do that. I can do that anytime. I could do it a few days after I put the money in there. Then I can transfer it to my spouse. Ultimately, when I pass away, it increases in value and transfers tax-free. And so there's nothing else in the Internal Revenue Code that actually does that. But my favorite feature in my laser fund is indexing. That did not even come around until 1997. I jumped on it immediately. My clients were so happy when I got their money out of the market clear back in 1980 when E.F. Hutton came up with the idea, hey, why don't we get rid of the volatility and the market risk of going down and put the money into a multi-trillion-dollar insurance institution. Some companies are only multi-billion-dollar. Oh, too bad. And this is the backbone of America and frankly the backbone of the world. This is where banks and credit unions put 30 to 40% of their tier 1 assets for liquidity and safety. Hutton was saying, let's bypass the middleman. Why put your money in a bank where they pay you 1 or 2% and they turn around and make 5, 6, 7, 8, 9% in the insurance company and increase the safety by like 6 notches? A lot of banks are only rated triple B. Most insurance companies where I put my serious cash are rated triple A. So you can increase the safety, but also the rate of return substantially. So this was the idea that E.F. Hutton had. Now, when I put my money in there back in the 1980s, I had clients transfer money into these and they were earning 11% and netting 10%. They were earning 15% and netting 14% because interest rates were high back then. Well, the last couple of decades, interest rates have been low. So indexing came out in 1997. Here's how it works. So when you apply indexing to your account, your laser fund, what you're doing is you're telling the insurance company, listen, I feel a little bit bullish about America this year. Just pay me the interest on your general account portfolio. Now, the general account portfolio is where these insurance companies put their money for liquidity and safety, and they put the vast majority into AAA and AA bonds for safety. And they might loan out some money on mortgages on skyscrapers and shopping malls, but they only loan out about 40, 50% loan to value. They don't loan out 80 to 90% loan to value. They're protected if we have a recession because they're in control and they have a huge cushion. They put very little into stocks. And so the general account portfolio rate back in the 80s was between 10 to 15%. The last 20 years has been down around 4, 5, 6%. So here's what it means. Let's say I had $1 million in my laser fund, and it doesn't matter if you have $1 million, 10 million, or 100,000, it all relates. So you can extrapolate from my example here. Any year that I feel bearish about America, I can say, just pay me the general account portfolio rate. Let's say that's 5%. That's $50,000 of interest on my million. And I can leave it there to compound tax-free. If I take it out, it's tax-free. You can learn about that by reading one of my books. But anytime I feel bullish about America, I say, you know what? You don't have to keep that $50,000 of interest on hand. I want to link my return to an index of my choice, and they offer indices. So one of my favorite might be the S&P 500. So what the insurance company does is they keep my $1 million safe in the insurance company, earning 5. What I'm giving up is the 5%. They take that $50,000, 5% of $1 million, and they buy upside options in the S&P, let's say. And so if the S&P, if the market goes up, they have the wherewithal because 50,000 of options might double to 100,000 or triple to 150,000. So if the S&P goes up 10%, they'll pay me 100 grand on my million or 150,000. And people say, how can they afford that? They're smart. The options mature to that. Now, if the market goes down, what happens? The options expire worthless, but I didn't lose my million. My million was safe. I only relinquished the 5%. Why do I choose indexing? Because historically, if you choose indexing, you will average 2% higher than the general account portfolio rate. So before, when I was averaging 8.2% for 45 years, I was able to nudge that up to 10.07% by implementing indexing, where when the market goes up, I benefit. But when the market goes down, I don't lose. And when you do that, do you know that Cresmont research says you take any 20-year period in American history, and if you bought and held, you'd probably average 9%. But in an IRA or 401k, a third of that belongs to Uncle Sam. If you earn 9, you're only netting 6%, because the other 3% belongs to the government in tax. So $1 million nest egg earning 9% would be $90,000, but you're only netting $60,000 to buy gas and groceries. Do you know what most IRAs and 401ks actually earn in retirement for people? 3.49, about 3.5%, because People are buying and selling at the wrong times. They panic when the market goes down and they sell low, and then they wait, and they buy in high. So the average is only 3.5%. This is why most firms only recommend retirees take out 4% a year. This is called the 4% rule. So let's do the math. You have $1 million, you only take out 4%, that's $40,000. You pay tax of even 25%, that's $10,000. Now you only have $30,000. Most money managers charge 1% on the million, so that's another $10,000. You pull out $40,000, you're only netting $20,000 to live on. How pathetic is that? That's a net return of 2%. In the laser fund, by using indexing, I have averaged 10%. Let's just say 8%. If I earn 8 on $1 million, I can pull out $80,000 tax-free. How much more is $80,000 than 40? It's double. But you're not netting 40 in a tax-deferred IRA. You have to pay tax and fees. You're only netting 20. I'm netting 8% out of my laser fund even after all fees. So why would I ever leave my money to the market volatility when I can participate in the upswings but prevent the losses on the down? Because Cresmont research says if you eliminate, for the last 50 years, if you eliminate the loss years, you don't make anything, you just eliminate those, and you only got 25% of the up years, you would outperform the market. Well, you can even do better than that by participating when the market goes up, and they may even cap you at 11% or 15%, but when the market goes down, you don't lose and you will come out way ahead. The most important part about indexing is the lock-in and reset. You lock in your gains every year. So for example, in 2017, many clients following this strategy made 16%, 25% on $1 million, that's $250,000. The next year, if the market dove 25, 30, 40%, they did not lose the $250,000, the 25% they made the year before, because every year using indexing, you make money, you lock in the gain, and it resets. So if the market goes down, you never lose the money you made in previous years. How incredible is that? So please watch this episode and you'll learn how the laser fund using indexing can protect you from the negative impact of taxes because it's tax-free, inflation because inflation works for you instead of against you, but most importantly, you eliminate the danger of market volatility.